Hey everyone, welcome to this week's Raising Millionaires podcast. I am your co-host Roger Bryan, and this is
Richard Lorenzen.
Today we're going to be starting on a journey of wealth building through real estate. What do I mean by starting? Richard and I have decided that we are going to start a real estate fund that invests in single family and multifamily duplexes in the Midwest, and we're going to open it up to investors so that they can buy in for both underlying asset appreciation as well as quarterly or monthly dividend cash flow distributions. We're going to build this instrument out live with you guys over the next few months and give you an opportunity to participate in it at any point once it is live and it is open for participants and investors. But I thought it would be fun to take you along the journey of how one of these things comes to life. One thing that you are going to see as we're talking about this is that there are going to be nuanced conversations about other types of investments and investment strategies because we are all complex investors. Real estate, dividend-based real estate, and property valuation, that's property valuation real estate investing. What the fuck is that? I'm trying to say real estate appreciation is a major part of a portfolio.
Yes.
Right? The property that I'm sitting in right now, right? I live in a small town in Ohio, and office space is scarce. So I took one of our rentals and I turned it into my office because it was better cash efficiency than going out and renting an expensive space in a building 30 minutes away when I can have this 6 minutes, 7 minutes from the house. Mm-hmm. I mentioned that because the appreciation, it's appreciated 60% since we bought it in 2017. So what is that? 8 years, 60%, right? You can say the S&P has done better, but this is a diversified portfolio. So we're going to be talking about all of those things and how it fits into an overall well-diversified portfolio that appreciates an underlying value. And the nice thing is, in many cases, real estate has cash flow as well. Richard, how does real estate fit into your portfolio today, or how are you looking for it to fit into your portfolio in the future? And tie that back into why we're starting a fund.
Yep. Well, I think when I think about real estate, to me, one of the primary advantages for why I like real estate, because as you know, I'm invested in a lot of other different things. Like I also do equities. We do some private investments as well. But real estate's unique because of the tax advantages that it comes with. To me, a lot of times, when I think about it, if you look at, for example, equities and real estate side by side on a non-tax adjusted basis, a lot of times the historical appreciation of the two asset classes have been somewhat similar. But when you adjust for the tax benefits of owning real estate, things that we're going to talk about, like depreciation, for example, that's where a lot of the magic really starts to happen, and you can see the advantages of real estate over some other asset classes. And so that's one of the things that excites me about real estate. There are so many tax benefits that you're able to take advantage of that make it a unique asset class to be in. And then obviously the second thing also being the cash flow aspect of real estate, which is something a little bit different than what you might see if investing in just normal equities or other types of investment classes. So for real estate, for me, it's the tax benefits, it's the cash flow benefits, the having cash flow. What about you, Roger? Why do you have real estate in your portfolio?
When I look at comparing like equities, let's say a high yield dividend stock that might pay 4%, right? Now I look at real estate from a cash flow and an appreciation perspective. I can get both, right? I can get the cash flow, which can be, it can be in the high 10%, it can be above 10%, but even if on average, if the cash flow net to me after everything is done is 4% of capital allocation, but the appreciation of the property is also 4%, right? I'm at 8% annualized return. Now you compound that over time, and at 10 years, I'm at 9.5%, 10% easily on that. So I look at it like this. I think this is the best investment that I can do for my children through a trust. is putting money in real estate where the value of the property is going to grow inside of the trust. And there's a lot of different tax ramifications based on the trust style or the different instruments that are used to buy it, but then also the cash flow. So I can buy it, put it in the trust, know that the appreciation by the time they retire is going to equal this, and then I can use the cash flow to put directly into an IRA as earned income.
Yep.
Different based on your how you approach taxes, but it can be almost self-funding then, that one instrument can then fund two long-term goals given the compounding nature of time. Warren Buffett, compound interest and things like that. It's beautiful. It's absolutely beautiful.
And one of the other things that's nice about real estate too, which is could also in some ways be said for other asset classes, but it's more complicated, is the ability to use leverage. To be able to, for example, if you have $100,000 that you want to invest and you're looking at equities and you're looking at real estate, you can buy $100,000 worth of stock with that cash, but you could also use leverage in real estate. In other words, you can use debt to buy a piece of real estate that's actually worth a lot more than that $100,000 that you have to spend. So that $100,000 could actually get you, let's say a $500,000 asset, putting 20% down in real estate as opposed to $100,000 in stock. And so that leverage also has the potential to be able to increase the cash on cash return that you're getting on your investment. And so that's a nice thing about real estate as well.
Yeah, and I think that you hit the nail on the head. If you look at it like this, if I can take $100,000 today and I can buy $500,000 in real estate, and if you're buying commercial, like rentals or multifamily, you're typically going to do, you used to be able to do a 10-year note and get positive ROI here. Now you have to do more like a 15 or 20-year note, right? That $100,000 with cash flow paying the bills along the way and still giving a spin out dividend is going to not only build to pay off at, say, in 15 years, that $500,000 asset, but then appreciation is probably worth $700,000. So you turn $100,000 into $700,000 in, say, 15 or 20 years, and you have a little bit of cash flow being pulled off. When I talk about a 4% cash flow return, right, that's while paying all of the underlying costs.
Yep.
It's huge.
Yep. And I think that's actually a good segue into talking about specific markets like the Midwest too, and like why we're interested in the Midwest, because I smiled a little bit when you said you started talking about 10-year notes and 15-year notes and cash flowing on those notes. Because I think that's reflective of the higher cap rates that you can buy properties at in the Midwest. Whereas in other markets, like here in New York, for example, even in a strong market, it would be hard to break even, let alone cash flow.
Oh yeah, unless you're dropping massive amounts of cash, right?
Because it's because in a place like New York or maybe on the West Coast in California, you're buying properties at a much lower cap rate than you would be buying if maybe you're buying in Ohio, for example, or in Pennsylvania or Indiana. So that might be a good segue into. I know that Roger, you're our Midwest market specialist. What is it about the market in the Midwest that you're seeing an opportunity in right now?
Yeah, with the interest rates above 5%, the dynamics change a little bit, right? When they were at 2.5%, 3%, it was the most amazing times, because what you had was called a negative debt to equity ratio. So that meant like you could go buy, and I'm just going to use round numbers to make it easy. You could go buy a $200,000 property, put $40,000 down, have a note for 160 over 10 years, and say that was a duplex with two sides. Your finance costs would be about $2,000 a month, but you would rent it out for $2,200 or $2,400.
Yep.
Right? So you'd be able to pay tax, insurance, and mortgage, and still have $400 a month left over for incidentals and coverage on a 10-year note. Why do I emphasize a 10-year note? 10 years in the life of investing is nothing.
Yep.
So that $2,000 a month that's actually being consumed out of the $2,400 in 10 years becomes net in your pocket, right? Minus taxes, insurance, which is going to be $300 or $400 of that. So you've got $1,500 to $2,000 a month in net return into your pocket off of that one property. Now with interest rates a little bit higher, you're going to go out to 15 years and you're going to be about break even, right? It's not
Yep.
as attractive, but it's still an amazing opportunity because it's paying for itself, right? That
Yeah.
smaller investment, that 40,000 in 15 years is worth 200,000 clean and clear, some cash flow along the way. There's no other way to do that. You're 5xing your money
Yep.
over 15 years. There's no other investment that can do that with the dependability and predictability of this
Yep.
style of real estate. So, Richard, when you take that opportunity, why start a fund?
Why start a fund? Because I think that it's going to give you the leverage to be able to go out and take advantage of some of these opportunities we are seeing in the marketplace right now, against a backdrop of, like you alluded to, the higher interest rates that we're seeing in the market right now, fear that we're seeing in the economy. Against that backdrop, there are less investors who are out there taking advantage of these opportunities. And so that's an opportunity for investors like us who are willing to go out and pull the trigger.
I want to watch this episode again a year from now. And one of two things are going to happen. We're either going to have been, no, because there's a couple things that could happen. There's going to be some reflection on how naive we were in some aspects.
Yep.
There's going to be some reflection on how brilliant we were, right? And then there's going to be some trials and tribulations and things that we have to change. I know right out of the gate, we were talking about doing an initial $10 million fund with the first round being about $1 million so that we can get a couple properties and infrastructure under our belt in order to show proof to go out and raise bigger money. We were also talking that like the first $1 million or $2 million we're going to use to buy properties all cash, no leverage.
Mm-hmm.
And then we'd be able to use those assets to help get leverage on the next 8 million so that we can double or even quadruple the amount of money that we can put into the market. And that over 15 or 20 years, that initial $10 million should be worth 40 or 50 in paid off net assets.
Yep.
Does that sound about what you were thinking?
That's right. That's right.
We also modeled out, and I'm putting this out there now so that we can reflect on this.
Yep.
That, right, the amount of cash that you put in should see an underlying 4% growth rate, capital appreciation just from the properties. That's not counting a multiple for leverage. And then you should see a 3 to 5% cash flow rate. It could actually, I think it's going to be higher if the models are done right. So you'll get cash every month deposited based on your investment, and you'll have appreciation of the underlying asset. So basically, you're never going to have less than what you put in, short of some major market correction, which has happened, but has always rebounded over given enough time, even after the Great Depression, right? It's always rebounded. So I'm not too nervous about that, right? What could go wrong? Because there are always something that can go wrong. Major market correction. What else?
And in the short term, you always see market volatility, right? Whether it's volatility in rental rates, right? Because we're talking about a strategy where we're going to be going out and buying residential properties, and we're going to be renting those properties out. You can see fluctuations in rental rates. You can see fluctuations in supply and demand in the marketplace. Right now, you're seeing a situation where there's a lot of demand, there's very little supply, so that obviously it's an advantageous environment.
Hasn't it been like that since the 80s, though?
It more or less it has.
Yeah, and I don't know what would change that supply side enough to make impact. Other than, like, if you deport half the population, maybe then housing would be a little bit cheaper.
Well, so the other side of that is that lack of supply could also become a challenge for us, as we look at, especially as we look to scale our own portfolio. Where do we continually find new assets that we can buy, or do we have to start looking at new construction, which is something that carries its own different host of considerations that we need to make, and so.
Yeah, that's why I like the idea of having 10 to 20% of the overall portfolio initially paid for in cash fully. It's going to give you so much more leverage after that, and a security blanket, right? That's a backstop if it needs to be borrowed against. If you do go into building and you hit with a delay, or somebody creates the most ridiculous tariffs and all of a sudden you can't get the supplies that you need to build.
Could that happen?
I don't know. It's like a crystal ball. I'm just looking out into the future just in case. So let's talk about the fundraising side in the instruments. Like, I know what I'm about to say is not super viable, but would be ideal, right? I was modeling this out and I was thinking about the fact that, right, if I as an investor wanted the perfect instrument and I wanted to put money in, like I needed to put, let's say, a minimum of 25,000 in, but then I wanted to invest $1,000 a month going forward in the fund, right? I don't know that that is, well, I guess if I'm accredited, certified, I put in the base initial capital, there's no reason why I couldn't continue to contribute until the fund closes. But I would, like, is it possible to open up a fund like this to the retail public without accreditation? Did you freeze on me? I think you froze. Hopefully we're still recording. Sorry, everybody. Technical difficulties on our connection for 1 second. We've not had this happen with this platform before. And now I'm here talking by myself. Hopefully Richard will be back in a second. At least it didn't shut down because he's actually the one that started the call. I don't know if in the future there will be the ability without significant regulation. Hey, you flip sides on me now. So did you hear what I was talking about from an instrument perspective?
I may have lost like just the last 2 minutes of it, but I more or less.
Okay, so right out of the gate, the easiest way to do this and the way that we're going to have to start is some type of like Reg D raised for accredited investors with a $25, $50, even a $250,000 minimum, so that we can follow all of the regulatory environments. The second stage from that, after you have a good base, is you could do a Reg A that allows individual investors to come in much smaller dollar amounts. It's not always advantageous to do that because then you have all the administrative burden, all of the accounting and financial burden, all of the annual filing burdens and things like that.
Yep.
But in an ideal world, having it as an instrument that people can buy and sell or invest in an ongoing basis. I like the idea of being able to invest in an ongoing basis because then it just becomes another one of those monthly contributions that I make for the kids that allows their portfolio to grow over time. I don't know if we're going to do that. The reason I'm saying all that is, again, when we reflect on this a year from now and we look at where we ended up, it'll be interesting to think about all the thought processes we had to get there.
Yep.
No, so define to me how you think this is going to work.
Well, I think in the long run, that would be the most ideal way to set it up, right? But in the beginning, we'll have to figure out how do we structure this. And I think you're right with, it's Reg D. It's something like, whether it's 25, 50, 100K minimum check size. Like, I think that's ultimately where we start. But the other thing we'll probably end up having to think about will be for a lot of these funds, they're built out in a way where there are separate individual funds, like Fund 1, Fund 2, Fund 3, Fund 4, that are going after specific acquisition targets. And particularly for a newer fund that's starting out, a lot of times it's easier to raise money for a fund that has a very specific, let's say, property or group of properties that the sponsor is putting under contract and acquiring through the funds that are being raised for that fund, as opposed to just launching, what they call a blank check fund, which is where a group of sponsors will come together and basically raise an open-ended fund that they'll use essentially in perpetuity to acquire properties as they see fit. It's harder to raise money for a blank check fund, especially for a newer sponsor, because it's harder for investors to kind of visualize, if you will, like what they're buying into if they don't see the specific property that fund is being formed to acquire, if that makes sense.
No, it does, and it's actually an interesting thing you and I haven't discussed before. So then really when you think about two parts, right, you have network, I almost said the word network marketing, but that's not exactly what I meant. But when you talk about network, what's the right word for it? Relational capital, right? If we're going out to plug into our network, then really what we're trying to do in the first phase is just get commitment letters to be able to propose deals, right? Hey, friend investor, I'd like to get you to sign a commitment letter for $100,000 that when we're ready to execute on a major investment in a group of properties, we're going to bring it to you, and that you have a legitimate interest in it so that we can go out shopping. But you're not going to give us any cash until the deal is packaged, put together, and presented.
Exactly. Yeah,
Okay.
a lot of the funds and the firms that I've seen that do this really well, and we have a bunch of clients that do, is they're always building that basically like a database of potential LPs, potential investors, who would be ready to commit capital if they like the deal. And then what happens is the sponsors, are going out, and this is what they do. It's a large part of what they bring to the table as a sponsor, is they're going out and they're scouting these deals and then structuring them and putting them together. And that turns into, let's say we go out and we find just for example, a 10-unit building that we decide is the right target for us to acquire. We would go as the sponsor, put that property under contract, put together the offering memorandum for that property, and then share that with the investors who we have, commitment letters or however you want to term it in our database. Bring them that deal and basically collect the subscriptions to that transaction. That's just one way that I see it commonly done. Like I get those offering memos, like as somebody who invests in deals, I get those across my desk all the time. I think I may have sent one to you recently in the last few weeks, for like a large apartment portfolio that was being syndicated. That seems to be a pretty common way that a lot of firms do it. Is they'll go out, they'll put the deal under contract, they'll structure the deal, and then they have a network of investors that they go back to on the back end, and they raise the money to acquire it. And that property would often be in its own kind of fund in one way, fund four, or whatever it might be. And that's how they often structure those transactions.
No, it makes absolute sense. So as we're thinking about this and we're getting the infrastructure put in place, like getting the PPM, the private placement memorandum, which is the document that allows you to raise as a Reg D, in place, and then also getting the database set up of those potentials and starting to outreach them to establish some baseline of interest, while also plugging into the local market to see what types of deals are out there. I know just recently there was a set of 4 triplexes that came on the market for like $900,000 each, with like a $900 monthly rental in the right school district, right? That would be the type of thing that you take out to the group then, and you convert and you buy and you put into the portfolio and you start to build.
And so that you said it was 4 properties and total of 9 doors.
4 triplexes, so it's 12 doors.
12 doors, 4 properties. Okay, and the total portfolio was $900K.
Yeah, I think it was like $895,000.
Got it. Yeah, so if that would be the kind of thing that if we wanted to pursue that, we would go, we would make an offer on that property, we would put it under contract, and then we would go raise money on the back end through presumably a Reg D, for a fund specifically to buy that property.
Yeah, I think the cap rate on that was almost 12.
Those Midwest cap rates, you can't find those anywhere else in the country.
Well, the other side of that too is that because interest rates are so much higher, right? It is advantageous for those that can pool funds and can bring the cash to the table, because it's harder for people to finance those deals.
Yep. I mean, that's the kind of deal, like it can be a slam dunk if you have the right partners that you can bring to the table, because what is that, $75,000 a door?
Yeah.
At a 12 cap rate. And it's $900,000. We're not talking about, huge amounts of money. You wouldn't need that many investors. Thinking about high net worth individuals, you wouldn't need that many investors to pull together $900K, buy it for all cash at a 12 cap rate. That kind of deal can be a slam dunk. It's a long-term cash cow.
Man, we should have started this a month ago. No, but I think this is a great conversation of laying this out, because I would love feedback from anybody listening to this podcast. Is this something you'd be interested in? Is this something that you've done and like we're just totally wrong, right? You need to do it this way, right? Let's talk. Let's exchange ideas so that we can get this right and we can make this work for everybody involved. I always do think about the transition from, right, private market, accredited investors to public. I don't know why I do that. Probably because I like the stress associated with trying to keep broke people happy. Yeah, let's just not do that.
Are you talking about going public? That's it.
No, the idea of letting smaller investors like a
Oh,
Reg A
okay.
or something like that. I think about my two previous funds, and both of them had some type of quasi element to them that allowed smaller investors in at one point.
Yeah.
And yeah, it's always a good idea.
I think the thing about a Reg A, we do have a lot of clients that do Reg A's. You need to have a platform where you can
You have to have a big audience.
where you can generate a lot of investors, because just the administration that's involved in doing a Reg A alone, like for it to be worth the costs and the resources that it requires to administer a Reg A, you know, it's really only worthwhile if you can raise a sizable amount of money from a considerable number of investors, in my opinion.
You know, one thing that I was thinking about too is that if you go out, and whether or not we do this, I have no idea, but if you go out and you hire a hired gun to
Yep.
go out and raise money for you,
Hmm.
what type of commission do they take?
Well, I think it varies quite a bit. Um, but you could think about, do we want to partner with a broker dealer, like a more traditional, like investment bank broker dealer that's going to go out and typically, you know, they're the ones who have a large network of clients on the retail side. So that we're talking about Reg A's again, like smaller investors, smaller check size, and then there are the ones that have the relationships with like the bigger institutional investors, private equity funds, that sort of thing. So you have to think about who your audience is, and which one of those broker dealers might be the best fit. There are also like crowdfunding, obviously, platforms that, you know, specifically are in that space, that also are licensed broker dealers, and also act as like they also provide the technology to do like a crowdfunding kind of mechanism. And so for a firm that's willing to build the marketing apparatus around it, you could also go that route, and it streamlines and kind of takes some of the administrative burden off your plate.
Yeah, a lot of different options there. I really think for a fund, this first fund in its size, that direct networks are going to be fine for us.
Yep. I think, you know, for us, it's an extension on the investing that we already do in our own private portfolios, and you know, it's also, again, like our private networks that we have access to. I think will complement that well, and so it's
The other thing that I wanted to do with all of this is, and you tell me if this is a good idea or a bad idea, is figure out how to structure it so that, like, I think about a lot of the clients that we work with that are high cash flow earners on a monthly basis, but aren't necessarily investors. Like, they would reach the qualification, maybe as accredited. I was thinking that they have the annual cash flow for the accreditation, but I just don't know if they've had it for 2 years in a row. Right? What do you got to do? Earn 200,
You have
file
to be an
tax
accredited
return?
investor. You have to have income of at least, it's either 200 or 250 for 2 consecutive years,
Yeah, that might
or
make it a little bit harder. But I wanted to make it so that we could help structure trusts for them, or provide them with a resource through our network that as they invest, part of it will be getting a trust set up for their investment for their kids or for themselves. I think that that would just be a great, like, sales strategy, right? That if you go, like, we both know a ton of influencers, small business owners, agency owners that probably reach the accreditation status with that, with their gross, with their income, but
Mhm.
have no knowledge. They may be buying stocks or crypto, but they're not really building out a
Yep.
long-term investment strategy or having long-term goals. And then helping them set up a trust and putting this in there now starts, like, 4 or 5 generations from now will thank them for doing it, even if they don't remember their name.
No, it's a good point. I think, you know, it would be some sort of hybrid between a services firm that can provide that resource of how do I set up that trust, right? And how do I build my plan and figure out my goals and how it all works together. And then on the back end of that, also having products, based for lack of a better term, that you can offer investment products like a fund, for example, or specific equity placements that somebody could buy into. So
I like that.
you have to figure out like how does that work in terms of how do you position it? What is the fee model? From a compliance standpoint, like how do those two things work together? It would be a lot of moving parts you'd have to figure out there.
And I still kind of like the idea. Um, we're going to do this under the Block Capital brand, right?
Right.
Okay. What else what do we need to be thinking about now? Like, if this is day one of Richard and Roger's real estate, I was trying
Well,
to be
look, I
simple.
mean, so for me in real estate, like I've always been a big believer in if you find the right deal, there will always be money
Yeah,
from somewhere. And so, especially for sponsors, the value that they're bringing to the, you okay there, Roger?
I was about to sneeze and it wouldn't come out.
Okay. I
uh,
wasn't sure if we were having a Mitch McConnell moment or what might be
oh,
happening.
jeez.
Um, so, really the value you bring to the table is initially the deal, right? Especially because the whole purpose that a lot of these LPs are investing into these funds is because they don't want to deal with having to go out and find a deal, right? And put that deal under contract and manage the deal. That's the service we're providing. So if you can find the right deal, I've always been a believer that the money, you find the money, like the money will always be there to raise capital to acquire it. Step one is being able to build a pipeline of those viable deals.
Yep. No, I totally agree. And I think you said something too that we've talked about in the past that we haven't mentioned on this call is that our approach to these entrepreneurs, those influencers, those agency owners, those small business owners is everybody does want real estate in their portfolio, but nobody wants to deal with the headaches of owning real estate rentals, right? Taking the headache out of the equation while still giving access to is one of the primary value props of all of this.
Exactly. Yeah. So let's take a look at that 900K 12 door.
It's already sold. That sold quick.
It sold.
Yeah.
So that's the other challenge we have to think about too, as far as like the order of things that we're going to be, because there are going to be a lot of moving parts that we have to manage, is especially in a market like this where it has been a hot real estate market for the last few years. There is still a supply shortage. How can we make sure that we're ready to move in time when we do find a deal that's viable? Because there are all those different moving parts that we have to manage in terms of getting interest from LPs and putting the structure of the deal together and all these different things. So that's a challenge that we may start running into as well because these deals sell so quickly.
Yeah, the potential LP list has got to be put together soon. And I always go back to like, if the first fund is supposed to be $10 million, you're going to do the first round as $1 million, right? Once you have that first fund done in the property inside of the corporate entity, right?
Yep.
Then you can go out and shop and put offers out with some sense of security that if everything else fails from a capital raise perspective, you have access to resources to still complete the deal. But getting that first one under your belt is kind of tricky.
It is. It's like the chicken and egg issue, the property, the investors.
Oh, I thought you meant that like egg prices were going up because all the chickens were dying from bird flu.
Well, there's also that, but I assume you guys have a lot of chickens out there in Ohio, so.
When I drive from my office to home, I will drive by at least 5 houses that have chicken coops.
There you go.
Yeah.
I don't see many of those here in New York. So.
No.
Okay.
I had a lot of jokes about what you would see in New York, but I don't think any of them are appropriate for this call.
And they're all true.
All right, let's close out this call with a little bit of a market eval.
Yeah.
So I was talking to Richard. I was looking yesterday and had my finger on the trigger. Tesla calls today ahead of earnings. Very, very small investment. I did not pull the trigger. And at lunchtime, I would have been up 50%. Now I'd probably be at par, even though Tesla's still up 4%. It was up 6%. The whole play on that, though, Tesla down almost 50% on the year. And at some point, he's already forecasted it, Elon Musk is going to tell people that he is done with his participation in Doge.
Okay.
Where would it most likely, or when would it most likely happen? On an earnings call, because investors are pissed. Like they want Elon Musk's head on a pike. So we'll be watching tonight on the earnings call, which I think is about an hour and a half from now. Does he make that announcement? Now, I'm not going to trade into this, right? Because there's less certainty around it than anything else. Like I don't have any foundational or historical model to tell me that that's a high probability like we do with Trump. He takes it to the last minute and then he does something to postpone. Like that was just a given.
Right.
When I look at the overall market, Richard, this was interesting. So Besant came out and said that he expects de-escalation with China from a trade war tariffs perspective.
Yep.
Trump has repeatedly said there will be absolutely no negotiation with China, right? The markets are up a little bit today based on, is it Besant or Besant?
Besant.
Besant.
Yeah.
So I said it wrong both times. Based on what he's saying being so contradictory of Trump, are the markets right to move up a little bit?
Well, you also have to think about like, is that strategic on their part? Like, is there a good cop, bad cop thing that's going on there?
We always talk about whether or not they're that smart, and we just don't.
You don't want to make any bets on trying to get into the head of anybody in the administration because it's just so unpredictable. But
I think ping pong balls bouncing back and forth.
I also think what you're seeing today is probably. I do think that overall the market has been a little bit oversold over the past couple of days. Obviously it's still very volatile and it's up and down every day. We're seeing.
Richard, I don't mean to cut you off. I needed to leave 3 minutes ago in order to be home when Claire gets on the bus, and I just saw the time because we started late today.
All right, get out of here.
That's probably the most brilliant thing you're about to say, but I have to go, or else I won't be home when Claire gets there.
All right.
See ya. Bye.